Welcome to this business tax roundup for this month. My name's Dean Wootten. First of all, we're going to look at a landscape gardener and landlord, and that was Anthony Callcott. Now, Mr. Callcott was a self-employed landscape gardener, and in October 16, HMRC opened an inquiry into his 1415 return. Now, at a meeting at his home, strangely enough, in November 16, he confirmed to an HMRC officer that his 1415 tax return was complete and correct. He maintained that he had no rental income, although he had remortgaged a property in the year. Now, on further investigation, HMRC requested an explanation of unexplained credits to his bank account. He then subsequently confirmed that some of those credits were income from a short-term rental property, which on the initial visit he claimed he did not have. HMRC then established that this property had been let out for 3 years. Now, the other unexplained credits, they must be trading income, and that unfortunately put him over the VAT limits, and he should have been registered for at least 4 years. Now, HMRC issued discovery assessments, and they backdated those under the presumption of continuity, and they raised penalty notices reduced to 60% for telling, helping and giving. That 60% seems rather generous because it looks like this chap deliberately misreported his income. So underdeclared his trading income and just didn't declare his rental income at all. Now, first he found that discovery assessments were perfectly valid. Mr. Callcott's records included false invoices, unrecorded cash and lots of other errors. And similar errors were made in prior years, so the presumption of continuity was appropriate. Mr. Callcott had failed to produce any credible evidence to displace that. The penalties were appropriate, and even the first year said they were a little on the generous side. The rental income had been deliberately hidden. He had provided HMRC with information that he knew was inaccurate. His return he knew was inaccurate. Comments to the visiting officer were inaccurate. Now, he should have also been registered for VAT, not through his rental income, but through his trading income, for the period April 11 through to July 15. And the VAT assessments which followed from that decision, they were not an appealable decision, because there was no returns to appeal. He would have effectively had one big VAT return to sort out for that late registration. So the appeal was dismissed. He had to basically deal with his errors, and he got lucky, really, with the penalty. So when we have clients in this situation, hopefully we don't, but I think early doors, if it's obvious that there's been errors, then we should really get onto the client and say, look, you should have told us this before, you obviously haven't. We now need to come forward and be absolutely clear as to what's gone on, and just to reduce those penalties, because you're going to get hit for the money in terms of income, etc. It's just trying to get those penalties as low as possible. But this chap got them 60%, and I think he got lucky. I wouldn't be at all surprised in other cases where it was significantly higher than that, because he had deliberately, on more than one occasion, submitted, confirmed, inaccurate information. Well, another similar case concerning Bobby Khan Enterprises Limited and others. Now, the company had 4 directors. Mohammed Asif Ali and Mutia Begum and their 2 sons, and they ran 4 convenience shops. On the 22nd of November 12, HMRC inquired into the company's affairs and the personal returns of Mr. Ali and Mrs. Begum. Now, this seemed to come about from information provided by suppliers of the business, and it became quite apparent to HMRC that there were significant volumes of purchases but which had not been declared. So by deduction, HMRC thought, well, if there's unrecorded purchases, that must be flow through to unrecorded income. So HMRC raised corporation tax and VAT assessments on the basis that the company had failed to declare all of its purchases and the resulting profits. And that was between 2010 and 2017. They treated the funds misappropriated as outstanding directors' loan accounts. And that gave rise to Section 455 charges, income tax, NI, etc. for the directors. And they also assessed Mr. Ali and Mrs. Begum on undeclared shop rental income in 1011. Now, the company appealed, and they blamed an ex-employee for making purchases for his own business. They also claim that the missing purchases were due to the accountant's carelessness, and they argue that the presumption of continuity should not apply as there is no direct evidence of suppression of purchases in any other year. Now, to my mind, this is very similar to the previous case we looked at. Yeah, a client has been found out, and they were obviously doing stuff which their accountant was just completely unaware of. But once you've been found out, then HMRC are just not going to let go. And I would say excuses like this are very easily seen through by HMRC. So up to the first tier it went, and the first tier ruled that the company had failed to keep adequate records, they didn't submit accurate returns, and they knowingly filed incorrect returns in order to minimise tax liabilities. The directors have provided little evidence, and what evidence they did supply was pretty much unconvincing. The accountants proved they'd frequently tried to obtain accounting details and records, but didn't look like they had a lot of success. HMRC's assessments were therefore made using their best and reasonable judgment. Presumption of continuity, once again, can be relied upon, as it's reasonable to assume that this wasn't an isolated situation. The suppression had occurred in the other years assessed. And what they tend to do in these situations is, if there is a corporate and under-declared income, the misrepresented profits, i.e. the income they're hiding, should be treated as directors' loans. The tax loss was deliberately created by the company's actions, so the discovery and the assessments were completely valid. So again, another case, client's been found out. I think really got to put your hand up, well the client has, and just try and get those penalties down. And in this particular case, because they trade for a corporate, interesting to see another first tier tribunal saying, if there's unrecorded takings in a corporate, then when correcting for that, the entry to correct all that is essentially via director's loan, because the directors have effectively had that money. It's in their pocket, so it should be via director's loan. Well, it's a case that we've reported on before on this service, but this is a high-level decision of the same. Now, it was HMRC and Mr. Neil and Mrs. Sharon Pickles. Now, Neil and Sharon Pickles ran their potato grading and processing business through a partnership. In 2011, they incorporated, formed a new company, and they put $1.2 million for goodwill, and that was left on loan account. Now, later the company entered into administration, but at that point, the Pickles had only withdrawn £770,000 from their loan account. Remember, that loan account started off as 1.2. Now, neither Neil nor Sharon Pickles declared any capital gain, because when you're transferring that goodwill to the company for a large sum of money, that should be reportable. Now, HMRC opened an inquiry into their affairs. HMRC valued their goodwill at $450 and said that's liable to CGT. And further, the excess of $750 was a taxable distribution, because there's $1.2 million sitting on loan account. $450 of that can be deemed to be goodwill, but what is the other $750? And HMRC said, well, it must be a distribution. Now, first tier allowed the appeal, concluding that the market value of the goodwill was even lower, $270 in their opinion. The distribution was therefore $501,000. The actual loan drawn down of $771 minus the goodwill of $270. The balance on the loan account, i.e. the undrawn amount, was $429. And that was owed to the directors. It wasn't a distribution. It's almost like a bad debt, so to speak. The HMRC appealed to the upper tribunal, with the Pickles cross-appealing. Now, the upper tribunal found that the first tier had erred in law. The distribution was the difference between the value of the asset transferred and the benefit received when the Pickles had a contractually enforceable right to receive the benefit. A third-party valuation calculated this value to be $1.2 million, and included in the sale agreement was that $1.2 million. So therefore that is what it was, $1.2 million. There's no basis to discount the debt on the basis that the company had only paid $771,000. So distribution was actually £930,000. That's the amount put into the loan account, $1.2 million, less the actual value of the goodwill, which was $270. So $930,000 is effectively a distribution. So HMRC's appeal was allowed. I guess on incorporations, we do have to be very, very careful with values, and we shouldn't be really putting into loan account fair value of assets, because if you're putting in more than that, then you're going to run into this problem. So what is that for? What is that extra for? And this particular one, they said, well, the extra is for distributions. And that's obviously something that we don't want. We don't want that to be assessed. So we want fair value, placed into the director's loan account, and then at some point, the directors can take that out. So we don't really want any extra in there, because that extra, according to the upper tribunal in this particular decision, is a distribution. So any excess over market value is a distribution according to the upper tribunal in this case. Well, let's now have a look at a few VAT cases. First one is EZEC Medical Transport Services Limited. And this company provided non-emergency patient transport services for various NHS trusts. Now, their vehicles transported patients to and through hospitals, doctor's appointments, etc. And they were configured to be able to transport patients and their mobility aids, including wheelchairs. Each of their vehicles could carry 8 patients plus the wheelchairs. And these vehicles have been specifically adapted for wheelchair users. There was a floor tracking system, and that enabled them to accommodate the wheelchairs on these ambulances. Now, the question in this case was the liability of the company's services, their income. Was it zero rated, enabling the company to recover its input tax, or was it exempt? So it wasn't about whether there was VAT on top of the income. There was no VAT on top of the income. It's whether the income was zero rated or exempt. Zero rated is obviously the one you want, because that gives you the ability to recover input tax. Now, both parties agreed that if the services did qualify for zero rating, then this took precedence under Section 30, Para 1 of the VAT Act. If something could qualify for zero rating and also exemption, then zero rating takes priority. Now, for zero rating to apply, the vehicles must be designed or adapted to carry 10 or more passengers. That's the zero rating legislation in this area. Now, this can be lower if the vehicle would normally be capable of transporting 10 passengers. But HMRC seemed to think that the vehicle must originally meet the 10 passenger rule and then be adapted to 8, say. Now, the first tier found that if the vehicle modifications were removed, i.e. they didn't have that tracking system, etc., then the vehicles would have been able to carry 10 passengers. The fact that they were designed to carry 8, in the first tier's mind, didn't deny the zero rating on the income derived from the transportation services. Those vehicles, they could carry 10 or more if they were not adapted specifically for wheelchair users. So in the tribunal's mind, zero rating should apply to their income, which then opened up input tax recovery on costs. Well, let's look at a Premier League football club. Always interesting to look at a case involving one of those. And this was Nottingham Forest. Now, HMRC visited Nottingham Forest on the 16th of April 18, and they returned on the 20th of April 18 to examine invoices and download some data from the new accounting system. And Notts Forest had changed systems. They were Sage, and they went on to a system called, I think it was Navision. And as a result of that transfer, there was quite a large error. I think it was about £340,000. It wasn't deliberate. It was just they changed systems, and there were some errors on the change. Now, on the 9th of May 18, HMRC received a memory stick with data from the old system, their old Sage system. Now, on the 29th of April 19, HMRC issued an assessment for £345,561, and that related to the August 15 return, which is where they had that accounting system changeover. Now, the club believed that the assessment was out of time, as under Section 73(6)(b), an assessment to correct a VAT return must be issued by HMRC by the later of 2 years after the end of the accounting period being adjusted, or 1 year after the date where an officer had evidence of fact sufficient, in the opinion of the commissioners, to justify the making of the assessment. Now, that 1 year rule is subject to the 4 year cap. Now, both parties agreed that it is the later 1 year rule that was relevant to this case. So when did HMRC have enough information to raise that assessment? Was it on the 20th of April 18, or was it on the 9th of May 18? Now, the club claimed that HMRC had sufficient knowledge to raise the assessment by the 20th of April 18. Therefore, the assessment on the 29th of April 19 was out of time. As far as the club was concerned, the old data was not relevant to the raising of this assessment. Now, HMRC claimed that the relevant date was then when they received the information from the old accounting system, and that was on the 9th of May 18. And in their mind, the assessment raised on the 29th of April 19 was within 1 year of that date, and as such was valid. Now, the tribunal found that it was for the club to prove why HMRC had failed to meet the 12-month deadline. They had to prove that there was enough evidence on the initial visit, or the 20th of April 18 to be more specific, that HMRC could have raised an assessment with the information they had on the 20th of April 18. The club had failed to do that, and as such they hadn't proven that the assessment was effectively outside the 1 year. So their appeal was unfortunately dismissed. Lastly, we'll look at Silverdor Limited. Now, this company provided services provider of short-term rental of hotels and service apartments, and they actually has disclosed agents for the hoteliers, etc. Now, the accommodation was booked mainly by businesses for employees on temporary assignments, and the company charged the hoteliers commission for advertising, dealing with reservations, etc. Now, when clients paid by corporate credit card, they would charge an extra 2.95% fee to cover the card company's fee. And this case is all about the liability of that extra 2.95% charge. Now, HMRC, they argue this was more for the reservation fee and therefore standard rated. And they issued an assessment for fees charged in the 3-year period between October 15 and 18. Now, Silverdor, they claimed that the fee was outside the scope of that. Initially, they said it was just a disbursement, and it was just the customer's fee, and Silverdor were just in the middle, really, and not really party to that transaction. It's just a disbursement. There's no markup on it. As far as they were concerned, the contract was with the customer and the card company. Now, if that wasn't right, they tried to then argue that it would have been an exempt financial service otherwise. First tier looked at this and they said, well, it's got to be a standard rate of reservation service. And because payment by corporate credit card doesn't change the legal and financial relationship between the parties. Silverdor is not paying or charging for the transfer of money. There's no separate supplier of financial service that could qualify for the exemption. So it's just more for the reservation service itself. The fact is that 2.95% was charged to the customer, whereas the commission was charged to the hotelier, didn't seem to matter in this particular situation. So unfortunately, the appeal was dismissed and VAT was due on those 2.95%. In hindsight, they should have, it could have easily been corrected. All parties have registered here, so why can't we just say, well, if the customers choose to pay by credit card, there's an extra 2.95% plus VAT, and everyone's happy. So it's just one of those areas where the VAT seems to have gone, not missing, but it doesn't seem to be addressed at the point of setting it up or charging extra. So we've just got to make sure in these situations that we address the VAT issue of all payments. And that 2.95% should have been a very important part of this. And essentially, the hotels should have been charging more for the room when the customers decided to book by credit card. And then it would have been fine. There would have been no VAT loss at all. Well, that concludes the roundup session for this month. My name's Dean Wootten. Thank you for listening.